Well, good Monday morning and welcome to Connect, the California MBA's weekly podcast featuring one-on-one interviews with movers and shakers in the mortgage industry. As you know, February is our month where we're talking about commercial real estate finance issues. And so we've got a great guest today. Excited to jump into the conversation with him here in just a minute. But first, let's have a word from our sponsors at Incelerate. So if you're looking to close more loans, again, in 2021, obviously, I think this covers just about everyone in the industry. If you're looking to do that, then check out Incelerate and experience Incelerate's award-winning customer engagement platform that features lead management, CRM, call routing, sales enablement, marketing automation, borrower engagement, and data intelligence through innovative use of multi-channel marketing, which includes text, social media, email, direct mail, phone, ringless voicemail, retargeting, and much more. So for more information about Incelerate and to schedule your personal demo today, go to incelerate.com. I'd also, again, suggest that you follow Josh Friend on LinkedIn. He's very active there and has a lot of good information and insights for the industry as well. So with that, let's jump into this week's weekly update, and then we'll get started in our conversation. All right, for this week's weekly update, I want to talk to you about 3 webinars that the California MBA will be hosting here in February. Starting on February 16th, our Legal Issues Committee will be hosting their first webinar of the year. These webinars are usually quarterly. And we'll be covering a variety of topics, including COVID-19 legal issues, an update on QM, an HR and employment law update, and we'll actually be having a CFPB update as well. Speakers for that webinar include Chris Cully with Mayor Brown, Natalie Vance with Kleindienst, Michael Flynn of Buckhalter, Nima Dagbanden with Gerasi, and Rich Andriano with Ballard Spahr. The following day, on February 17th, our Mortgage Technology and Marketing Committee will be hosting their monthly webinar. This one will be titled How the Convergence of Consumer Direct and Retail Lending is Ushering in a New Era of Digital Lending. And we'll be featuring 2 great speakers, Josh Friend with Incelerate, and then Mark Foley of Homestead Funding, as well as our moderator and one of the committee co-chairs, John Soroka of Soroka Brand Development. And then finally, towards the end of the month, on February 25th, our Mortgage Quality and Compliance Committee will be hosting their monthly webinar. And this one we focused on social media marketing compliance, obviously a very, very timely topic these days. Speakers will include Philip Yee with Plaza Home Mortgage and Mike Zastapil with Black Knight. So if you're interested in any of these 3 webinars or any of the events the California MBA is putting on these days, make sure to go to our website, cmba.com, and click on the events tab, and you can RSVP for any of these webinars right now. All right, well, let's jump into the conversation now. I'm excited to welcome in Brad Zampa. Brad is the EVP, or one of the EVPs at CBRE. He is leading the Debt and Structured Finance Division for the Northern California Capital Markets Institutional Properties team. We actually featured him at our Western States CREF conference back here just a few months ago. And so excited to bring him back in here now as well. Brad, welcome.
Great to be here.
All right. Well, let's start at the beginning here. Let's talk about your background, find out how you got into the business on the commercial real estate finance side, and specifically how you got involved in the debt and structured finance sector.
Sure. So taking a walk down memory lane here, I come from a real estate family, really. My dad was into development and leasing, predominantly in the retail sector for, well, probably 50 years. And so it was always in my blood. I always knew I wanted to enter in the commercial real estate. I just didn't know kind of how and that I was going to go about it, whether it was going to be development, leasing, finance, sales, all the above. There's a lot of different ways to start a career in commercial real estate. So actually what I did, and I was also interested in law, so my entrance into the mortgage banking field was a little untraditional in that I went to law school and studied real estate law, thinking I want to be a real estate attorney, passed the bar and started working at a firm, realizing that it was not my true calling, it was not my true passion. I ended up spending a lot of time in a library doing research, and it just was not for me. So I started interviewing and networking and meeting a ton of people in the Bay Area in the real estate world. And I had actually met a few gentlemen that had left CBRE, what a small world it is, to start their own mortgage banking firm. I started as an analyst, and we were raising debt and equity for real estate projects, commercial real estate projects on the West Coast. And I learned a ton over a 7-year period. And then I went out on my own, being a real estate attorney and a broker. I figured, why don't I just do this myself? I think it was time. My relationships within the smaller firm had started to, I think they had exercised themselves, if you will, and it was time for me to move on. And I started working out of my house, and I had several clients that were feeding me mostly mortgages, some equity raises. I was by myself at my house, newly married, no kids. I had a Yahoo email address and a fax machine, and it was unsustainable. At one point, I think I had 500 million under app by myself. I had no help. And so I was approached by a few gentlemen that had also left CBRE and gone over to Cornish and Carey at the time, which is now Newmark Knight Frank. And we formed Cornish and Carey Capital Markets back in 2004. We grew a team of investment sales professionals and debt professionals, and we had a ball with our little group, and really were highly successful, mostly financing office, industrial, a little bit of retail, and some multifamily deals. But that synergy between investment sales, brokers, and debt brokers really kind of grew, and we're all chasing the same clients, and so it really kind of shone the light on how powerful a partnership like that can be. Until 2008, 2009, when the market imploded, and we were all sort of sitting there staring at each other, and we ended up kind of going our separate ways. Gentlemen that I was partners with at the time, they had gone over to HFF. I stayed at Cornish, and then really what happened was Cornish was getting sold to Newmark Knight Frank. It was taking too long. I ended up speaking with Chris Ludeman and Brian Stoffers over at CBRE, who ended up hiring me, and I formed a new team, which is where I am today, with about 20 person team at CBRE covering investment sales and debt placement. Great,
yeah. Well, and I have to imagine that law degree you were had to be in the back of your mind there about 2008, 2009 as a potential factor, right?
Oh yeah, we all were advisors and workout specialists and chasing special servicers for deals that really never materialized. I did help certain clients, engage in workouts, some successfully, not so much, and was making a little bit of money doing that. Mostly just doing it for free and really getting credibility amongst clients for when the market kind of turned. They'd remember me that way, and so I got a lot of brand loyalty that way.
Sure. Well, and I have to imagine. I mean, we haven't had. You're right about it being a bit of a unique, entrance into the market. I haven't really spoken to too many people who got their law degree first and then kind of jumped into the business. But that has to come in handy when you're going over deals. And I mean, people talk about the commercial side of the business being so relational focused, and it is. I mean, from what I can, from my vantage point. But it's also got to be so detail focused, and it has to come in handy that law background with a focus on all the research that you had to do, and just the detail oriented nature of that law degree has to come in handy.
Well, it certainly helped, especially early on in my career, being that I had credibility when I spoke to clients, but I also had confidence. And so when you're starting out as an analyst, and then you move into doing cold calls, and you got to get in front of clients, trying to convince them to trust you with their deals, you better be confident because they'll see right through it. So that helped a lot. And then today, I don't get involved too much in the legal aspects, except for maybe bringing attorneys to a close where they're really running up big bills on unnecessary covenants and loan docs, and I just step in and say, hey guys, I know what's going on. I know that that I know what's going on. So let's bring it to a halt. So that helps. That helps a lot, saving clients money.
Absolutely, absolutely. Well, let's fast forward to the present right now, then, and let's get your take on big picture. Where are we at with the state of the commercial real estate finance market right now, and maybe what are the biggest pain points from your perspective? Yeah.
So finishing. 19 going into 2020, the market was just absolutely on fire. Every product type was going gangbusters. CMBS market was on fire. Life targets, debt funds had raised an inordinate amount of money. And the commercial banks, regional banks, international banks were all chasing, all product types in commercial real estate. Stopped, and nothing really happened for about a month. And then what happened was lenders started getting back into the market, the government started pumping it up, and agencies came back. So everyone chased multifamily. In fact, our multifamily teams had record-breaking years last year in terms of volume. So Fannie and Freddie once again saved the day. They did it back. They do it every cycle. They're there, which is great, particularly if you're at CBRE and you're a multifamily specialist. These guys are good. They've got great practice. They've got a great platform to work off. Then the industrial market came back, and a lot of it having to do with Amazon and the fact that work from home, people are shopping online. You can't leave your house. Shelter in place. It was pretty obvious. The industrial market was already on fire, and then it took off, and it remains that way. And then slowly, about in the summer, single tenant office, long-term net lease deals, particularly in the suburbs, started coming back for obvious reasons. Starting off with credit, investment grade credit deals with 7-year, 10-year, 12-year terms, very safe from a lending standpoint. That came back, and then really what started happening is the kind of the multi-tenant suburban office came back and is still back for obvious reasons. You don't have elevators, you don't have lobbies, you control your ingress and egress, you don't have public transportation, you can leave your house, jump in your car, park, go in your office, not interact with a lot of people. It's actually sad, really. It's a 180 from where we were at the beginning of 2020. Fast forward to today, the debt markets have come screaming back. All lender types are back, or they should be back, or they're going to get blown out because there's so much money on the sideline chasing deals, whether it's acquisitions or refinances. The urban cores are still hard. CBD is still hard. Tower business is still hard, especially for the office sector. But I suspect it's going to come back, especially once we get the vaccine rollout straightened out. And then if you go from out the risk spectrum, so you go from multifamily to industrial to office, then you go retail. Retail's been getting a lot of headlines as a bloodbath, but grocery anchored retail and drug anchored retail is hot as a pistol for obvious reasons. Try go to a Trader Joe's right now. Try going walking into a Molly Stone's. It's packed. Try going to a CVS. I mean, so that's pretty obvious. And then lastly, the hotel market, hospitality market's really taking it on the chin. Destination hospitality, like luxury hospitality. So, think Silicon Valley, think, I use this example, Edgewood and Tahoe, predominantly because it's in Nevada, but those type of hotels are actually doing really well. But you go to a convention center hotel or a downtown hotel, and it's pretty distressed.
Yeah. So, I mean, you mentioned a couple of them, the suburban markets and industrial, but what would you say maybe are those the biggest opportunities or bright spots in the market right now?
So, yeah, a couple things. One is, the industrial market continues to perform extremely well. A lot of the suburban vacancy, low-rise suburban vacancy, kind of industrial R&D, is getting converted to life science. That's the new play. Everybody's a life science expert, which is encouraging, and the lending community likes it. The issue is, could it be a bubble? Is it going to get overbuilt? And maybe the wrong players are getting into life science, and they're going to have to compete against the big boys, Biomed, Blackstone, Alexandria, that have been doing this for years, and that have race now. Just keep an eye on that, because to think that you can have life science in downtown San Francisco is a little hard to imagine. I'm not saying it's not possible, but if too much space gets converted, then you have very expensive space with very weak credit, a lot of it startup credit, and that's a recipe for disaster.
Right. So, I mean, you mentioned
that's really where,
go ahead.
Yeah, that's really where I see opportunities right now. Some of the life science is going to do great. We're looking at a big deal in downtown Seattle that's very promising. We have several life science deals on the market right now, but tell the market, if you're a broker, that you're going to take a dilapidated mall and turn it into life science is going a little too far out on them, in my opinion.
Yeah. Well, how far do you expect that life science trend to continue? I mean, will that continue, beyond 2021?
Who knows? I think it'll be interesting to watch to see how much absorption, and if the demand's there, developers will continue to build. Right now, the demand is there, but at some point, you just don't know how long it's going to last.
Sure. Well, and speaking of crystal balls here, let's talk office space, and in particular, how, where do we go from here, and as far as post-pandemic and the work from home and reality now, what's your crystal ball telling you, for the next?
We spend a lot of time talking about this on calls every day, both internally at CBRE and externally with clients. Nobody really knows, right? We're all guessing. Big picture, I think, once again, the suburbs are benefiting tremendously from COVID. I mean, Silicon Valley is performing extremely well. Very little sublease space on the market. There's actually been some leasing going on, if you read the headlines, down in Silicon Valley. So that's all positive. And then you flip to San Francisco, and it's a bloodbath, right? We're approaching 20% vacancy between sublease space and direct space. Rents are falling. No one really knows. So you're going to have a great reset. Just like every cycle, this cycle is, every cycle's got their own nuance, but this isn't new. Same thing happened in early 90s, .com in the early 2000s, great financial crisis, and here we are today. It's another black swan event that no one saw coming. And it just takes time. So we'll get the vaccine, and companies at some point are going to have to, start saying it's going to be probably a hybrid model. I think 3 to 4 days a week in the office and maybe a day of work from home. I think maybe senior level management probably might be out of the office a little bit more. But I think from a younger person's perspective, when you're trying to break out in the business, you got to get in the office. You got to be near your boss. You got to absorb the culture. You need a mentor. There's no way you're going to advance on a Zoom call sitting in Park City. It's not reality. And some people are going to choose lifestyle, as always, and some people are going to choose to get back in the office. So we just need a reset. We need to know where rents are. We need to know where demand and occupancies are before you can really start underwriting. All the value add deals, I'm using San Francisco as an example, have been pulled from the market because sellers aren't willing to sell. Sellers don't need to sell quite yet. You have really low interest rates. Most landlords in San Francisco are under-levered, and they can hold on for a long time. And so most don't need to sell. So all that distress that everyone's waiting to see, there'll be some, but it's usually a lot less than people think. Just like it happened in 2010, there was only 3 or 4 really distressed deals in San Francisco. But pricing is going to definitely come down. I think we're down 30%, 25 to 30% right now. But it's going to come back. Silicon Valley and the Bay Area always reinvents itself. There's always new entrepreneurs, there's always new startups, and they're going to need office space. Maybe not as much as they needed in the past. There's some school of thought that says that they're going to need more space because they need people to spread out more, right? More square footage per employee. So some people think it's a wash. I think it's going to be a combination. And it's too early to know. We don't really know what the other side looks like, but once again, Silicon Valley reinvents itself every cycle. And there's always these headline risks of a mass exodus. And there are companies that are leaving for political reasons, for tax reasons, for cost of living reasons, but the talent is still here. A lot of the talent is still here. And if you need to grow a company fast and scale it, you need employees, they're here. And so a lot of the mass exodus, you got to realize, even CBRE moved from down, we're moving our headquarters to Dallas. We're not leaving California. We're just moving our headquarters. And, I got to be careful what I say, but I think a lot of it has to do with taxes. So California, we have a tax problem, we have a pension problem, we have a lot of problems, but the talent is still here.
Right. And I think you're 100% right on especially younger employees coming into a company, and even a newer company trying to build a culture and build some of that camaraderie. You're going to have people in the office. So I think. Well,
I miss the office, and I'm fairly senior, and do I have to go in? No. Do I want to go in? Yes, I want to mix it. I want to feel the energy, the collaboration. With collaboration, there's ideas. With ideas, there's deals. And it's pretty obvious. People are going to need to get back in. Whether it's 3 days a week or 5 days a week, that's up in the air. And actually, who does need to be in more than others? All that, and a lot of it's going to be based on company. What do they want to, dictate, right?
Yeah. Yep.
But I'm all for. I mean, how productive can you? I have a home office, right? So I'm lucky. But if you're 30 years old and you're sharing an apartment and you're all Zoom calling from your kitchen, I mean, how productive can you actually be? And at first, the first 6 months of COVID, I was like, this is great. We're in these companies, Salesforce, Google, Facebook, Apple. We're productive. We're super productive. Now, what's coming out of Silicon Valley, productivity is down, and it's pretty obvious. And so there's anywhere from 20 to 30% productivity is down, is what they're estimating. And for sure, our company has to be the same.
Yeah.
I know I'm not as productive at home. There's no way.
Oh, absolutely.
I mean, we're doing deals and we're busier than most, and we're getting it done, but not at the level we were when we were all together in the office. I miss all my team.
Throw into that, workers that have kids that are at home. That, I mean, you can only lock the door for so long to have a Zoom call before someone pounds on the door or an emergency breaks out.
I have 3 boys in the house on 2 are in half day school, 1's full-time Zoom. I mean, it's awful. It's really hard. We're all talking over each other. Everyone can hear each other. I mean, we have, thank God, we have some space where we can spread out, but it's not easy.
Yeah, no kidding. So let's switch gears here a little bit here. I'm curious to know your take on this. Are you starting to see some of the development resume on some bigger projects? Are we still waiting for more of the shackles to come off, whether it's the vaccine or lifting of government sanctions?
No, we're seeing, I mean, it depends on product type, right? So are you going to see a Class A office tower go up right now? Probably not. We have several that we're going to be marketing, one in Oakland, one in Bellevue. Probably not quite ready, but if you think about it, it's not that far off because you're going to build right through the pandemic and the recovery. So it's not terrible timing. It's really hard to underwrite right now because where are rents, right? Where is occupancy? How do you underwrite absorption, lease up time, things like that? But that will come, and it's not that far off, I don't think. When you talk about multifamily, there's a ton of development going on. When you talk about industrial, there's a ton of development going on. When you talk about life science, there's a lot of development going on. Are you going to build a shopping center right now? No. Are you going to build a hotel right now? No. So it's really market specific, and it's really product specific. But construction financing is in the market. I have a construction loan right now that we just signed up for a data center in Silicon Valley, $50 million loan. It was priced significantly wider than it was pre-COVID, but the financing's there. So, I suspect that you're going to see, a lot of developers dust off old plans and start to get ready.
Gotcha. So, I'm curious, the projects that you talk about and some of the deals, especially on the commercial side, are always so complicated, and not always so complicated, but often complicated, and obviously high value. And so what's your secret sauce here? I'm curious, just from your perspective, what's your secret sauce? What's the secret to navigating these deals?
I can't let you in on all my secrets.
What's that?
I can't let you in on all my secrets. No, I mean, it's pretty simple and elementary. Honestly, I mean, it all comes back to relationships. Which is, all ties into the fact that we need to get back together in the office, at conventions, in meetings, things like that. But relationships are key, having high level lending relationships to make sure that, there's mutually assured destruction if there's a mistake made. And I've built relationships over time with all the, big institutions and lenders. We had some pretty scary deals go sideways last year, putting them back together. I think a lot of it has to do with having senior level relationships, but also what CB has unique to a lot of my competitors is really good information and really good data. I can pick up the phone, I can go to research, I can get comps. I mean, appraisers call us for information. So we deal with so much data. We have such great leasing brokers, up and down the coast that I can lean on. Great investment sales professionals that we've built incredible relationships. So that relationships and really good information and data is how you get complicated deals.
Yeah. Well, I would imagine too, especially having all the resources of CBRE has got to be, an asset in a time like this.
Yeah, 100%. And that's why I think a lot of the smaller mortgage banking shops struggle in down cycles, because they don't have real-time data that we have, and they can't jump on a phone with 5 leasing brokers and have a nice conversation on a Zoom call. I mean, that's all I do. Most of what I'm doing all day, I've had as many internal calls as I do external, because we're all trying to figure out the market. And we have, I get, time. I'll just tell you, I get a internal Bay Area letter. And to tie back to San Francisco and all the bad, the bad headlines, and everyone's leaving, and it's a bloodbath. I'll just tell you just really quickly. I'm going to run through just San Francisco alone in January. VC funding, Radiant, 13 million raise, A round. Dorvest, 2.5 million seed round. Starship, 17 million. Husky, 70 million. Lone Pal, 800 million U round. Club Fees, Unfold. All these companies, I could go down the list. That's just January. There's 25 different raises, 30 raises right here. And they're going to need office space, right? But this is the kind of information that they're constantly feeding us as brokers, which really elevates our game.
Yeah. Well, and again, I think that we talked about it last week on the podcast, but I think that's a great example of why, major decisions and policy shouldn't be made by headlines, because if you read just the headlines right now, you think that everything is in the tank right now, and, we're facing imminent, destruction on the commercial side. But, last week we talked to Gary Bechtel. He had a great positive outlook, and you've got one too.
No, I really do. I'm used to this. This is my 3rd cycle probably. I guess you could call it 4th. I don't know. And it's the same. It takes a couple years to work through and reset. We're in a big reset in the office market, particularly in our urban core, CBD. Seattle, if you go to Seattle right now, it's boarded up. If you go to down San Francisco, it's boarded up. In Seattle, one of the hottest submarkets right now is Bellevue and the East Side. You would have never thought that Redmond would be hot. It is incredibly hot. It's one of the hottest markets in the country. Silicon Valley is performing beautifully right now. Is everybody in occupancy? No. Is everyone paying rent? Yes. It's also just got a ton of credit. These startup companies from 10 years ago, Google, Apple, the fame stocks, if you will, they're all credit companies now, and they're not going anywhere. And so I think the headlines are completely overblown. It just takes time. You got to be patient and let the distress work itself through the system.
Yeah, it's a good perspective.
If we get a vaccine, I'm guessing, Q3, Q4, we're going to have a lot more clarity of what the other side looks like.
Yeah, well, I think everyone will appreciate some more clarity for sure. So final question here. Let's switch gears here again. I'm curious from your perspective as someone who's been in the industry for a long time now in a senior position, how important is it for industry players to support the advocacy work of organizations like the California MBA, the MBA, and on the commercial side, groups like NAIOP?
Yeah, it's imperative. It's 100%. And once again, we go to Zoom calls and it's not quite the same. You need to be in there. That's the best networking you can do is ULI, NAIOP, mortgage bankers, CREF. All those industries are so crucial to growing as an individual, personally and professionally. I didn't realize it until probably last cycle, and I ended up joining NAIOP. It was so valuable. I met so many great people. I still attend the events. I sat on the board. ULI is fantastic. The Rosen Conference, fantastic. All those, especially if you're younger, it's imperative to grow your networking and to learn and get involved. You got to get involved. You got to, really get behind the scenes and not just show up, but be part of some of the committees, be part of some of the events somehow. You got to be involved. And, and even for someone senior, it still keeps us connected with.
Yeah. Well, and speaking of events, we've got our Western States Commercial Real Estate Finance Conference, the Western States CREF, coming up here in September. And it's going to be, at this point, we're planning on it in person. So hopefully you'll be able to be there in person, and we'll be able to, shake hands and, high five after all the.
Well, I miss that event. That's a must attend. I miss that event every year. But all those events, usually, this is what it is. So it's February 4th, right? So I'm on the road every week at the end of January and into February. I bounce up and down the coast, meeting with clients, going to events. That's a part of the industry that I miss greatly.
Yeah, you'd be at the MBA conference.
MBA, and also mixed with there's a private equity conference down in Laguna, IMN, that I used. Yeah. It's also in a very nice place too. In the wintertime, it's great to be in Laguna.
Yeah, it's true. Absolutely. I'm sure that's not an accident. Well, hey, Brad, thanks again for joining us on the podcast. It was great talking to you and catching up. And hopefully, like I said, we'll be able to see each other in person here in September at the Western States Crep.
Hey, thank you. It's been an honor.
All right. Well, and if you like the conversation here, if you enjoyed our chat, then make sure and subscribe to our channel here on YouTube. You can also follow us and listen to the podcast on SoundCloud, Spotify, and Apple Podcasts. And we'll be back again next week for another episode of Connect. We'll see you then.